Well, guys, it's been a pretty big week, and honestly, I'm pretty happy with the way things have gone overall, broadly speaking, especially for those in the commodity space. I think on the macro, as you continue to see yields roll over in all time frames, I think this is very good because this is likely confirming that we topped here. All right. And considering that this was a very, very, very powerful 41-year trend, the odds that we come down for the retest and break back down and then come back up to try to, retest this top, it's not likely. I just don't see that happening. I think that we topped. I think that we are rolling over on rates. This only gives us a couple of months before the Fed pauses rate hikes, okay? And once that happens, the whole game has changed, all right? And you got to understand that as these yields catch a bid and they fall, it's just taking the ceiling out of how high the Fed can raise, right? Because what sense does it make for the Fed funds rate to be 2% if the 10 year's 2%, right? So this is going to steal all their thunder. And for those who would counter this argument with quantitative tightening, I don't think it's going to happen, guys. Like, to any extent that they tighten and start to unwind, it will be for narrative only to say that they did, okay? So they can save face. I don't buy it one bit. I think any tightening they do will be very short-lived. We'll get into that later. But first, we really need to talk about the broad markets because this is going the way we want it to. So this is very good. I think fundamentally everything we're expecting and our whole strategy to this point is playing out. This is really good. So sitting on the weekly, we're going to start with the Dow Jones, and it's staring you in the face, right? I mean, you have the March 2020 key level to come back and test. Consider this. Just consider, if you never have before, what does the world look like today compared to right here in this moment? February 2019, before the pandemic came, before everything changed. It's worth reassessing our valuations, isn't it? And it makes sense to come and compare at least to this level, okay? Before all of that money was printed, before all those policies were made, before all those companies went out of business, right? Before everybody lost their job, before all those stimulus packages, it just makes sense to come reassess where do we stand today compared to then, first of all. Second of all, look at the confluence you have with the 200 at that exact spot. And just below it, you have another strong level that would act as support as prior resistance in this megaphone pattern before that breakout, okay? So the Dow Jones is really, I think, telling you where we're going. Let's say if you fell there from the close today, I mean, it's only 5%. It's only another 5% down. You can do that in a day. Now, the question, of course, is what happens next? Well, I'll tell you. First of all, you can look at history as a guide. And I'm just to show you for reference, on the weekly time frame, we have 1, 2, 3, 4, 5, 6, 7 red weekly candles in a row. 7 continuous weeks of selling off in the S&P. How does that stack up historically? Well, typically, you max out around 6, as is pretty clear, right? 6 is a lot historically. Well, there are 2 other occasions with 7. One of them is right now. You just finished it off, right? The other is in 1980. You got 7 there. There are only 2 other occasions in the S&P's entire history where it went on a longer losing streak than the one we're on right now. And that was in 1970 and in 2001. And just for reference, to show you what happened after these events, take a look at the charts. So starting in 1970, we got 8 consecutive weeks of selling in a row, okay? Just monster selling. Now, granted, the 9th week did sell lower, but it closed higher, okay? So it wasn't a red candle. That being said, that was the bottom. A significant bottom, by the way, that went on to, run on to the next major bull market. Now, you go next, 1987 red weeks in a row, okay? What happened there? You put in a significant bottom. You went on to put on the next bull run. Now, 2001, 8 more red candles in a row. While it wasn't the bottom, this was the bottom about 6 months later. You did put in what? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 weeks of continuous advancement in a bear market rally before you capitulated and rolled over. All right? 9 weeks. You got almost all of it back too, by the way. So this really begs the question, knowing what I just told you, how does that make you feel? How does that make you feel when you look at this S&P chart? Sitting what? Hold on. Sitting what, 7% above this 200 EMA, which has confluence with this 3,600 level that we've been talking about for how long, right? How does that make you feel? You're only 7% away from that. You could do that in a couple days. You could certainly do it in a week and then get 8 candles and tie the all-time record for the most sell-offs ever, right? The most weekly red candles. How does it make you feel when you put that into perspective? In terms of time, the sell-off has been significant, okay? In terms of magnitude, there have been sell-offs far more violent, far worse, but certainly in terms of time, we're getting there, right? I mean, we're getting there. It's getting really drawn out. And as bad of a bear market as this may be, it's hard to argue that we're not due for the bounce. Consider also this. This is the CDX High Yield Index 5-year spread. So typically when spreads get above 500, it's screaming that there's a problem in the market. And you can see the confluence of going above 500 and the impact it has on the market. You can see that there's correlation directly with prior market sell-offs with these high yield spreads, okay? Typically also the Fed has a tendency to intervene once you get above 500. I mean, almost always. I think they have a perfect record of intervention once you get above 500. So I want you to consider everything I've been talking about up to this point in these prior videos about, we've got Q2 GDP coming, right, in 2 months. We've got inflation numbers coming. They only need a marginally better print, right, just for the sake of the narrative to say that inflation is on its way down, all right? As you're going into a bear market, a recession looms, credit yields are exploding. I mean, what do you think the Fed does next? Do you really think that they start tightening at $100 billion a month? By the way, if you're wondering where I got the charts, I got some here from QF Research. He's worth a follow on Twitter. Absolutely real smart guy. And then, of course, one of the best finance websites of all time. And you know what? Maybe you disagree with me. Maybe you're like, nah, man, there's no way we're going to get a negative print on Q2 GDP. And we're not going to go into a recession. Well, maybe you can tell me in the comments below what I'm missing. Because, I drive a V8, I drive an F-150, and it costs about $130 to fill that baby up. And just for reference, just to put that into perspective for you, if I fill up twice, okay, that's $260 in a month. All right, if I only fill up twice for the month, all right, I could go get a loan for a car. $15,000, no money down, no trade in, 5 years, 5%, and the payment would be less than filling up my gas tank twice. You think this is sustainable? How long do you think we could put up with this? It's only going to get worse. I mean, it's going to be $6 by the end of summer. $6. You understand? I mean, that same $130 fill up is going to cost what? $200. So yeah, I think this has been the time to buy. I think we're going to be entirely vindicated on our strategy. I think this is all playing out the way we totally expect it to. Now, if something changes, I will acknowledge that and we'll change along with it. Adaptation is survival. But until something changes, this is it, baby. This is where we're going, and you just need to keep stocking up on the good stuff. Now, talking about the good stuff, we're going to start with silver, all right? Because silver and silver equities might be among the most undervalued commodity stocks right now. I mean, they are just dangerously undervalued, and I'm in love with the whole sector right now. That being said, spot price. It's working on putting in this spring. It's got a tough confluence right here, the 200, and this key resistance to get back above to finalize and affirm this Wyckoff accumulation pattern. And I'm telling you guys, if it gets above and it can settle down and retest this level and hold, we are taking 30 faster than you just don't understand. No, you don't. It's going to happen. If it fails, if it rolls over, then I would be looking for a V bottom on the near-term price. I'm talking $1, maybe $2 down, all right? Something like here, right here, maybe this right here, tops, all right? But if we don't V bottom on that and come right back, then I would be very worried about silver. I just don't see that happening. It looks good right where it is. I'm buying. Now, when it comes to gold, I want you to think about everything we've talked about up to this point and in the last video, all right? Everything as a summary up to now. The significance of the yields, the bonds capping and rolling over, okay? And how that usually implies, typically, the Fed's going to pause or roll over in a month or two. This is extraordinarily important, guys. One of the reasons is because as soon as the Fed pauses and or turns over and starts lowering rates, that's always when gold starts the next leg up. Always. All right? Always. And this is imminent. Don't worry about the narrative. Don't worry about all the crap you're reading. Don't worry about what the Fed says. They're a bunch of liars. They're a bunch of shills. You think they're going to come out and tell you the truth? People will be, you understand? Like, you got to understand the difference between reality and narrative. This is all narrative, right? And right now, their narrative is working. They're getting the markets to do what they want it to do, but it's just noise. Understand that the reality is catching up quickly, all right? And the Fed is going to pause, if not completely roll over and capitulate. And as soon as they do, that's it. Your chance to buy is over. So we're going to speak broadly over a few silver companies right now. Obviously, AG had a nice rebound here on this lower support trend line. It's a very long-term trend, very strong. Now, what I expect to happen, to be honest with you, is you're seeing this in a lot of the things we look at. Gold, silver, fertilizer, uranium, whatever it is. They're getting a nice bid here on these major supports, okay, as the broad market continues to go lower. And I think if you look at what the broad market needs to do, like we talked about up to this point in the video, right? We have like another 5-7% lower to go, maybe another weekly red candle or something, right, to get to those major lows. It makes sense for us to get these up a little bit so that they have room to fall with the broad market again. And think about how that would look. You'd get the nice, everything's red all over again, massive fear. Oh God, we're going lower. Bear market official all over the news, headlines, people get scared. And then you really start to get more capitulation. Wouldn't surprise me at all to see that. So I actually honestly kind of expect this upward movement really just a buffer to help you fall less. That's what I'm looking for. That might not happen. I think if you're looking to get into silver and you don't own any, you absolutely need to be adding positions here at these levels, especially if you're long term. I mean, if you have any kind of long-term outlook, you need to be buying right here. We are certainly, probably, most likely at or near, very near the bottom, right? So you just need to be accumulating, because however this plays out next, certainly you can expect something like this, okay? We've talked about it before, maybe a W bottom. It's all roughly the same thing over time. Just be adding, right? Just be cost averaging in from here. These are extremely good levels. So just to look at a couple of the big names, they're getting aftermarket rallies. That doesn't really mean much, but look, we came down, retested the level, and we're coming back up. You know, it wouldn't surprise me at all. Come back to the trends, right, on the daily, and then come back down for a retest. Just would not surprise me at all. If we V-bottom here and go up, great. You know, I'll be cheering the loudest and the most. I just don't expect that to happen. Again, to reiterate again, excuse me, I'm kind of getting sick, guys. You're just looking to accumulate. Just accumulate. However it shapes out, you just want to accumulate and add for that next leg up, all right? Because things are probably going to be a little bit shaky for a little longer. And it's not necessarily just going to, zoom up for you. You have work to do, all right? So the worst may be behind you in terms of violent downside, all right? But now it's a gut check to, just kind of average in and accumulate your position, because I can almost assure you that's exactly what they're doing. We're going to look over a couple of the big names for more reliable clues. NEM, all right. We talked about this one last week. It was, a little bit sketchy. Closed above the 50 on the weekly. Very good. Daily, making a break on the up. Maybe rounding out a little bit there on the bottom. I like that a lot. I'm liking what I'm seeing. But again, I see the potential to come up. You have a double confluence of resistance here, not only in the 50 on the daily, but previous resistance that became support will now be resistance again. And I just see a potential for, to get a deflection here, okay? And whether we double bottom or not, I don't know. But I would expect to see something like this, okay? I can see it playing out. But with that being said, it is moving the right direction, all right? And, you're getting green weekly candles after everything going on in the broad market. It's just confluence, and I like it. Yamana green on the week. Let's take a look here. Yep. So this all looks super good. And again, would not surprise me to just chop around, right? This is where you want to be accumulating. AEM finishing up strong up here on the weekly, back inside the bullish trend. All right. Again, wouldn't surprise me. Come up, retest, get rejected, and just accumulate sideways for weeks. It wouldn't surprise me. I'm just trying to drill this in your head. Hopping in uranium, we're going to start with Cameco. We're going to start with the big boys because they offer a much more reliable picture. And so you can see that we came up on the daily and we're riding that 200. It's offering some resistance here, but the weekly candle was a strong close. I mean, we closed above the 50 after a nice wick on this trend line. So, if you're just looking at charts like Cameco or Nexgen, I mean, absolutely, there was never a reason to freak out. There was never a reason to panic. I mean, everything is perfect, right? And that's the kind of retrospect I want you to have, because this is the kind of thing we tried talking about before it happened. Just be cool as a cucumber, because we're going to come back to that Wyckoff level, and that's where you want to be buying again. And I still think this is true. I don't think anything has changed. I think the lower market caps, like we addressed before, they fell through those Wyckoff levels. They didn't hold the same. That just makes them a much more steeper discount for your information. But in terms of charting the bottom, I mean, this has panned out extremely well, and we're holding up exactly. And so going forward, I would just expect this to continue. I think, considering if you watch the gold and silver section, I'm just going to reiterate, I think that the broad markets have a really good shot at just taking one more week down, right? And just flushing out another 4 or 5%, touching those key levels. And this little run right here will give us the cushion we need to sell off with the broad market. And then you can come back for this retest. And if that happens, if you can get that kind of confluence, if you can get the S&P to hit 3,600 and the Dow to hit like 30,000 or whatever it is right there, the same time we come here on Nexgen, I mean, that is just the most bullish buy of all time, because it's just going to fly. All right. But maybe that doesn't happen. Maybe it doesn't. It doesn't really matter. You need to be buying in here anyway, because this is accumulation, right? After distribution, you get accumulation. So either way around it, you need to be accumulating. And since I expect us to come touch this trend line again, I encouraged and recommended people to use the bounce to reallocate. And I did some of that myself. The tranches of Nexgen I bought down here, I flipped for about a 5% profit. Right, as I did with SMR, I flushed back up with cash. And it's funny thing about selling SMR too is I sold it like right here. And I went out in the garage to work out, and I came in an hour later, and it had fallen all the way back down here. So it ended up getting about an 8% net swing trade for me. But I still have the cash, and it's ready to deploy should we come back down here and test these levels, which is entirely reasonable. It just makes complete sense, especially if you look at the way uranium likes to trend anyway. I mean, it really likes putting in W's, double bottoms. It just likes to do it. So it stands to reason that you would just put in another one here, come back for this retest if and when the broad market takes one more leg down. So I've never talked about John Deere before, but this is a company I've tracked for years. And if you want to see a long-term chart that has stood the test of time, I mean, that is the strongest bull channel going back to the mid-60s that I've ever seen. Okay. And you can see that when we got here to February 2021, we broke up, and it's been riding. But right now, it has fallen back below. All right. And that is a big deal to me. I think this is a pretty big signal, and it's something that we should be watching. I think the broad markets will go back down a bit more. I think we will get those targets that we looked at, those March 2020 levels. And I think things like this are kind of telling us that that is coming. And just to reiterate, in the agriculture sector, I still just don't like the way that a couple of these are looking right now. I think IPI is a bit better. Still, now that you're down here, you at least want to see how you react around this $51 mark. I think if you are an existing holder, you keep holding. I don't think it's something to sell. It's definitely something you want to add to. It's just about when. And considering everything we've talked about up to this point in this video, I think you would look for just a bit more downside. Honestly, look at the confluence you would get right here. We haven't touched that 50 yet, and I think you just have to touch it. So what's the too long didn't watch summary? First of all, 6, so I'm sorry if you noticed. Number 2, you have to be confident. Above all else, you must be confident, right? In your convictions, the fundamentals. You can't be led astray. And you have to understand that all of these headlines, all of this news very seldom is actual news, right? It's just narrative generation, right? And this stuff is not meant to guide you. It's meant to mislead you. Right. And I hope most of you are, old enough to have figured this out by now. Right. You need to stay away from this crap. I don't care who says it. I don't care where it's from. I don't care how official it is, right? This crap is noise 99% of the time, right? You are responsible for educating yourself, right? And verifying what you can with your own eyes and with your own time. And I'm telling you, this fundamental thesis behind everything we're doing is going to play out. All the stars are aligning for everything we're doing and talking about, okay? Not only in the near term, right? Not only in the near term in terms of the Fed and GDP and inflation and the bond market, right? All this stuff is lining up perfectly. And so is the long term. So are 6 months and beyond, right? You are in the perfect place with the perfect opportunity to accumulate. Accumulate the things that you know are going to grow in value substantially over time because they're fundamentally irreplaceable, right? You just need to be confident enough to strike. Just strike. Because without confidence, it doesn't matter how right or wrong you are. None of that stuff matters. Right? You can have all the knowledge and wisdom in the world, but if you're not confident enough to act on it, then it's all for naught. So my summary is hold tight, guys. Be confident because this is all going the way we thought it would. I mean, after all this downside, after all this selling, we ended up right where we expected to be months ago, right? So you shouldn't be afraid. You shouldn't be shaken out. You should just be adding, because I can tell you with confidence that's exactly what the big guys are doing.